Why agency owners trust their numbers but fear their future. At this year's Build a Better Agency Summit, somebody ran a little experiment on more than 300 agency owners. No survey, no spreadsheet, just the board on the wall and a sheet of emoji stickers. 300 plus agency owners, 5 questions. And that wall told the truth in a way a survey never could. Here's what it showed. Agency owners feel great about their numbers and they're quietly terrified of their future. Same room, same people. Let me show you exactly where that fear lives and the one discipline that erases most of it. So let me set this up because the credit here isn't mine and I want to be straight with you about that. This comes out of the Agency Management Institute, Drew McClellan's world, from their Build a Better Agency Summit in Denver. Somebody put up a board with 5 categories. The 5 foundations of agency financial management. Financial reporting, forecasting, profitability, cash management, and sales outlook. And they just asked people to slap an emoji sticker on each one. How do you feel about this? A smile, a shrug, a worried face, gut reaction, no thinking. Now, I've worked with a lot of AMI members over the years, so when I saw what that board looked like at the end, I didn't blink. I've had this exact conversation across the desk more times than I can count. Here's the direct answer to what the board revealed, and then I'll walk you through each category one by one. What is the confidence gradient? The stickers formed a gradient, a slope on the left, financial reporting, almost every sticker was a smile. On the right, sales outlook, worried faces, anxious faces, more poor ratings than anywhere else on the board. So kind of looking backward, it was confident. Looking forward, it was anxious. And the categories in between, they slid down the slope in order. The more backward looking the question, the better people felt. The more forward looking the question, the worse they felt. And that's really the whole finding. Agency owners are confident about where they've been. They're anxious about where they're going. And I want you to sit with that for a second, because that gap between knowing where you've been and knowing where you're headed, that gap isn't just uncomfortable. That gap is exactly where financial risk builds. Now let me walk you down the slope. 5 categories, a real fix in each one. Reporting. It's necessary, but it's really not enough. Category 1. Financial reporting. This was the happy end of the board. Nearly every sticker was a smile. And that's good, but that's the good news. Most agencies have accurate, on-time financials. Your P&L shows up, it's clean, table stake. Here's the trap though. It's real easy to believe that good reporting equals good financial management, but it doesn't. Reporting tells you what already happened. It does not tell you what's coming. It doesn't tell you if your margins are actually sustainable. It doesn't tell you what a slow quarter does to your cash 3 months from now. And I see it constantly. The financials are beautiful, delivered on time every month, and then I ask one question. What does your next quarter look like? I get a pause or a guess. If your reporting is solid, great. You build the foundation. The only question that matters is whether you're building anything on top of that. Now, forecasting. Consistency beats sophistication. Category 2, forecast. And this one had the wildest spread on the whole board. Roughly equal numbers of good, fair, and poor, so it's all over the map. Some owners clearly have a forecast they trust. A lot of them are flying on gut. And look, I get why forecasting is hard in this business. You're project-based, revenue is lumpy, scope shift. A client says, let's push it to Q3, and a profitable quarter goes flat overnight. It's harder than forecasting a subscription business, and that's the truth. But here's the thing I want you to hear. The agencies that forecast well are not the ones with the fancy model. The difference is not sophistication. Like everything else, it's consistency. A simple forecast you actually maintain beats a complex one you built once and abandoned. A simple process. Connect your sales pipeline to expected revenue, track your utilization, model the cash impact. A simple process you can actually keep up with will beat a beautiful, complicated model that you built one time and never touched again. Every single time. Start simple, keep it current. That's the whole track. Category 3, profitability. And this one was interesting because it wasn't angry, it was confused, uncertain. The stickers here weren't worried exactly. They were unsure. Owners can sense that their margins aren't where they should be. They just can't see why. And I know this pattern cold. The agency is growing, busy, landing new clients, and somehow the profit doesn't grow with it. You're working harder, but the bottom line won't move. And it almost always comes down to a lack of visibility. You can usually trace it to one of the 4 leaks: service mix erosion, scope creep, utilization gaps, or no project level profit data. 1. Service mix erosion. You took on lower margin work just to fill the calendar. 2. Scope creep. You're delivering more than you priced and never adjusted the fee. That's a whole video all by itself. Number 3, utilization gaps. You're carrying capacity that isn't consistently billable. And 4 is the big one. No project level profitability data. You know the agency is profitable overall. You have no idea which clients, which services, which teams are actually carrying it, and which ones are quietly bleeding you. I've lived that. Profitability isn't one number at the bottom of the P&L. It's margin by service line, by client, by team. When you can see it at that level, you can finally make a decision about it. Until then, it's functional but reactive. Category 4. Cash management. This one landed right in the middle of the board. Not a crisis, but not confident either. Cash is managing fine until you're not. Most agencies are managing cash okay in the short term, reactively, no real plan behind it. And here's the danger with reactive cash management. It works until it doesn't. One client pays late, one surprise expense, one slow new business month, and suddenly there's real pressure, especially in an agency that distributes most of its profit and keeps the reserves thin. Which now brings me to the thing I say to every owner who sits still long enough to hear it. Profit and cash are not the same. A beautiful P&L can still bankrupt you because the P&L says you earned it. The bank account says it hasn't shown up yet. You can be profitable on paper and still sweat the 15th and the 30th. So here's the fix, and it's not real complicated. 2 moves. Set a cash reserve target and build a rolling cash flow forecast. 1. Set a defined cash reserve target. A common one is around 10% of your annual revenue, a number you don't dip below. But each agency is different. We typically like somewhere between 3 and 6 months of operating cash. Now, if your clients are recurring clients and playing the same thing, maybe we can look at 3 months. If you kill what you eat, you definitely want 6 months. Every agency is different. 2, build a rolling cash flow forecast, a simple view of how money actually moves through the business week to week. That one discipline will turn cash from a source of anxiety into a source of control. Category 5, sales outlook, the fear category. Category 5, sales outlook. And this was the striking one, the far end of the slope, the most negative reactions on the entire board. The most emotional, the worried faces, anxious faces. This is where the confidence ran out totally. Agency owners are uneasy about what's ahead. Pipeline visibility, client retention, pricing pressure, the market. The forward-looking sales picture is where they feel the least in control. And here's why this one matters more than any other of the 4. Because sales outlook uncertainty cascades into everything else. If you don't know your next 90 days of revenue, you can't do anything else with confidence. If you don't know what revenue looks like in 90 days, you can't forecast. You can't hire with any confidence. You can't plan cash with any precision. The fear at the far end of the board is actually driving the anxiety in every category to the left of it. So what's the fix? You connect the sales pipeline directly into the financial forecast. You translate your opportunities and your probabilities into projected revenue and projected cash. When your sales visibility goes up, the confidence in every other category tends to follow it back up the slope. The 6th category that never made the board. Okay, so that's the board. 5 categories: backward confident on the left, forward anxious on the right. And here's the whole point of that exercise in one line, drill nail. Reporting tells you where you've been. Advisory tells you where you're going. Now, obviously I'm a CPA, so I'm going to tell you something they didn't put on that wall. There was a 6th category missing from the board, and it's the single most backward versus forward one of them all: taxes. Think about how many agency owners do tax. You get to March, your accountant adds up what already happened last year and hands you a bill. That's it. That's a smile face category. It fails handled, but it's pure rearview mirror. By the time you see the number, every decision that could have changed it is already behind you. And this is the exact same trap as the reporting category. Filing a return feels good. It feels like good financial management, but it isn't. It's just documentation of what already happened. This is the difference between a tax preparer and a tax advisor. A preparer looks in the rearview mirror and tells you what you owe after it's too late to change it. A planner looks through the windshield, Proactive planning is forward-looking by definition. Before the year closes, you decide how the entity is structured, when income lands, which strategies you are legally entitled to use so that more of the margin you fought for all year actually stays with you. So look at the whole board again with me. Every category on it was really asking one question. Are you looking backward or forward? Reporting backward, forecasting cash sales forward, and that's where the fear lives. Every category on it was really asking one question. Are you looking backward or forward? Reporting backward, forecasting cash sales forward, and that's where the fear lives. Tax is the same question. It's the one place where looking forward instead of backward can put 5-6 figures back in your pocket that you'd otherwise hand over for no reason at all. That's the whole game. Stop managing your agency out of the rearview mirror. Keep more of what you make. So here's what I want you to do this week. One thing, pull up that emoji board in your head and rate yourself. Reporting, forecasting, profitability, cash, and sales tax. And then add mine, tax. Where are your worried faces? Wherever you flinched, that's not a weakness. That's just the forward-looking work you haven't built the discipline around yet. And most of it is simpler than it feels. And if the flinch was on the money side, the cash, the margin, the tax, that's exactly what we do. Head over to CraigCodyandCompany.com and let's talk. All right, before you go, if you're an agency owner and you want to keep more of what you make, I've got 2 things for you. First, grab a copy of my book, The 12 Biggest Tax Mistakes That Cost Agency Owners Thousands. It breaks down the exact mistakes I see every day and how to avoid them. Second, if you want to see what this looks like for your business, get a free tax analysis. We'll take a look at what you're doing now and show you where you might be overpaying. And if this video helped you, make sure you subscribe so you don't miss future strategies on tax planning, cash flow, and building a more profitable agency. I'll see you in the next video.